So we continue with this IFRS 15. After this, we just did this step 1, features of a contract. So we said that step number 1 was identify the contracts. Okay, this one, step 1, identify the contract. So first we need to understand what is a contract and what are the conditions which must be met within a contract. So we just did it. Then you also have one more thing within that, combining multiple contracts, which means that you might have different contracts when you can put them together and make it one contract. So we call it combining multiple. So you have actually, one is like, contract adjustments we make, existing contract we make adjustments, and sometimes you have existing contracts, you put them together and consider them as one contract. So we say contracts are combined if they are entered into at or near the same time with the same customer. So the time is same, the customer is same, if either the contracts are negotiated as a package with a single commercial objective. For example, this is, you agreed with someone to make a residential site, and that residential site includes, I don't know, 4 building blocks. So it is possible that you make separate contracts for all of them together, and it is possible that you combine all of them together. So combining the simple contract, because it is a single commercial objective, construction of this residential site. The consideration for each contract is interdependent on the other. It is also possible that this is also a condition that consideration for each contract is dependent on the other. So sometimes you say, delivery of some goods and installation of some goods. So you are asking for some kind of air conditioning system in your building, and that air conditioning system, it includes the equipment and it includes the installation. Okay, so equipment without installation or installation without equipment does not make any sense. Nobody would buy just equipment or just installation. So it has to be a package deal. You might be having a separate contract for these two, because equipment you imported on someone's behalf and services you are buying from a local company. So there is a local company who says that I am an agent of some company in Belgium. You make payment to this company in Belgium, they will send you the equipment, and once you get the equipment, I will make installation. So I make a contract with the Belgium company for delivery of this air conditioning units, and then I make a contract with the local company to come and install. But because they are considered, but these are interdependent on each other. So these contracts can also be combined. So we say combining multiple contracts, and the overall goods or services of the contract represents a single performance obligation. A single performance obligation means that completing that construction site, which includes 5 buildings, or maybe installation of an air conditioning system in our building, in our office. So ultimately, there are 2 different performance obligations, but these 2 performance obligations, they satisfy one single performance obligation, which means establishment of, that air conditioning system. You might have contract modifications. So when you have an existing contract and you change some term and condition, so will it remain the same old contract you can modify, or is it necessary to create a new contract? The question is that I already have a contract of provision of some services with my customer, with my client, and then client says, do this thing also. Now that's an additional requirement, and that additional requirement might come after 2 months, 3 months, 6 months. And by the way, we have got a lot of variations. We call them VO. What is a VO? VO is called a variation order. Variation order. Now I'm telling you from my past experience, because I've worked in oil and gas, and in oil and gas, we have contracts for 3 years time period. We sometimes have contracts for 5 years. We make a contract with BP, we make a contract with Total for providing some kind of services, and contract is for 3 years. So after 3 months, 4 months, BP sends a VO, then they again sends a VO. then they again sends a VO. So during 3 years, they might issue 6 or maybe 8 or maybe 10 variation orders. Variation order means that, slight changes to the contract. And why do they do variation orders? Because for variation order, it is possible that existing contract will remain in place and we will just attach one annexure to that. And it is easy from legal point of view, from operational point of view, because if they want to make a new contract, then that is a long process. They have to go for the tender again. After the tendering thing, they have to make comparison, choose this, how to say, best supplier, negotiate with them, draft the contract, approve the contract, read the contract. I give it to my lawyer. It's an 80-page document. It's a 90-page document. Even if it is coming from the BP for the same thing, but because it's a new document, I will have to send it to my lawyer to read it again. Maybe on page number 37, they added few more words which are going to kill me in future. I can't take the risk. I have to reread the contract by my lawyer. So sometimes making new contracts becomes so tiresome activity that it looks unnecessary. So instead of, making a new contract, you make variation orders in the same contract, because when you do variation orders, you don't have to go through the entire exercise. You just call your supplier and you say that, listen, this is the contract which we already have. This is something which we want additional. Let's agree the price, and you also do this service for us under the same legal contract. So you save 3 months of effort. Honestly, I'm telling you, like large scale contracts, 3 months is like this. It goes like this, finalizing the contract, because in their company, they have several approval levels. They have procurement department, they have commercial department, they have supply chain department, they have legal department. It will go through everyone. Then the same process will happen in my company. So it takes a lot of time and effort. So there comes a solution which is called contract modifications, and we do modifications. It's like a very common thing. So contract modifications are accounted for as separate contract if and only if. So modifications are possible. You will only consider them a separate contract if the contract scope changes due to the addition of distinct goods or services. If the scope of the contract changes, which means the nature of the job changes, or the change in the contract price reflects the standalone selling price of the distinct good or service. So maybe you are adding some particular item which is sold in market separately for $15, and you are adding it into the contract again as $15. If this is the case, then it is a separate contract. But if you are adding it here for $14 or maybe $13, then you can consider it as a modification. It says the change in the contract price. So contract before was 100, okay? And we want to add something additional. And that additional thing has a price of $15. So if you add $15 here, it becomes 115. So the contract price reflects the standalone price, of the distinct good or service. If you are adding it at 15, then it is not a modification. Then you can actually go back and make a new contract for 15. Modification is only there, okay, the separate price is 15. Under the same contract, I'm putting it as 13. I make it 113. So these are the two conditions here. Number one, the scope of the nature of the job does not change, which means, let's suppose I'm doing transportation for someone. So it remains transportation. Let's suppose I'm doing construction for someone. It remains construction. It does not become construction plus selling or construction plus renting. Okay, so I'm constructing and building and giving it to you. You cannot say that, after doing construction, you also let it out. You also do maintenance of the building. No, yeah, that's an example. So whenever you talk about commercial buildings, maybe a business center, that business center has construction. It is completed and handed over, and then there is maintenance. So if you say construction, and let's add a variation order for maintenance of the building, it is not variation. It is not variation. It is something different. Variation means that maybe construction is for 15 floor. Now you can say add one more floor. So for this is variation, that before initial contract was for 15 floors. But then you said, let's make one more floor and make it a 16 floor. I can call it a variation order. But if you say after doing construction, you also will do the maintenance of the building, this is not the variation of the existing contract. This is something different. So here you need to go for a separate contract. You need to make a new contract. Contract modifications that are not accounted for as a separate contract. Not accounted for as a separate contract. So these are separate contract. You have to here, you need to make a separate contract. If the scope changes or if the price is of the same price as standalone. And these are, which are not separate contract, these are modifications. So these modifications are replacement of the original contract with the new contract, old contract with the new contract, if the remaining goods or services under the original contract are distinct from those already transferred to the customer. Number two, continuation of the original contract. Original contract continues and it just, how to say, a renewal, we call it a renewal of the contract. If you do the renewal. And a mixture of 1 and 2 if elements of both exist. It could be like mixture of 1 and 2. So either it is replacement of the original contract with the new contract. You make a new contract, but the essence remains the same. Essence remains the same. The scope of the work does not change. And the price of the work does not change. So these are not accounted for as a separate contract. It is the same contract. And number two, continuation. So two words, replacement and continuation. Continuation means that you have a contract, it finishes here, and then you continue it again. The renewal comes in. And for renewals, you don't have to go for the tender again. It is very important to understand. Like, don't think like you are making a contract for purchasing some small piece of equipment. Believe you me, you have large contracts valuing over $500 million, even more. And these contracts are huge scope of work. If you make a renewal, it is always easy. It is always easy. It involves less technical and legal and operational hassle. So these are called renewals. Same terms and conditions, just renew it on the previously agreed things. So whatever we agreed before, the terms and conditions, the prices and stuff like that, you make a renewal. And here I tell you one trick. Which is actually like we have loopholes and everything. And I'm telling you the commercial side of that. We knew that we have this contract and which is done for $100. And the client says, let's renew it for the next 1 year or 3 years again. And let's do it, keep it for 100. Because if you keep it for 100, I will consider it as continuation. And I don't need to go for, making the biddings and requesting the offers, going for tendering, then screening of the suppliers. We will save time, you will save time. I said, you know what, here I need $10 more because it is I cannot afford to do it for 100 anymore. I was doing it for 100, fine, but from next year I want to take $10 more. And you know what the client says? I have seen it many times. They say you sign the contract with 100. After 2 months or 1 month or 3 months, I will give you a variation order. And in that variation order, whatever you will perform the services, I will add something more and I will give you benefit in the variation order. And it will save you time and it will save us time. We know that we have to give you $10 more. We agree that we have to give you $10 more. But if we try to give 10 more here, then continuation will be a problem or replacement will be a problem. So let's do it with 100 so that we are not bothered for the new contract thing. It's a continuation. And then we add one variation order and we know that we have to somehow compensate you $10. We will compensate you later on. And this works. This works through variation orders. We manage it. Initial contract is in place. Later on, keep on adding variation orders. It will save you from hassle. So this is the practical side of these large scale complex contracts. Step number 2 now comes. Now, I spoke a lot on step number 1, which was identify the contract, because that was an important side of this thing. This is easy. Step 2, identify the performance obligations, which means within the bigger work, the building, how many separate performance obligations you are going to have. And performance obligations are the contractual promise by an entity to transfer to a customer distinct good or service, either individually, in a bundle, or as a series over time. You know, I told you performance obligation could be selling a car with warranty. So one performance obligation is delivery of the vehicle, and the second obligation is providing you the warranty. This is bundle. Two things: delivery of vehicle and provision of services. It could be individually. I'm selling you a mobile phone, that's it, without warranty or whatever. Or it could be a series over time, something which will be repeated over a period of time. Just like I gave you example, these lessons, 16 lessons or 20 lessons. So these are called performance obligations. The criteria are activities of the entity that do not result in a transfer of goods or services to the customer. Example, certain internal administrative setup are not performance obligations of the contract. So if we say that we are going to plan or make this building for you, and making this building means digging the foundation and stuff like that, whatever. So we say foundation and structure and external facade, internal fittings, furnishing, whatever. These are performance obligations. But my internal planning, I will sit down with my project manager. They will make some planning document. You know, they will do some project planning. These are not performance obligation. These are my internal administrative setup activities, and I cannot charge you for this. I cannot come and say you have to pay me because I make some project planning for you. You will only pay for digging foundation, making structure, and etc., which were part of the building. These are not performance obligations. So it's important to understand. The two criteria for performance obligation are to be met. Number 1, the customer can benefit from the good or service. The customer can benefit from the good or service. Like I told you that in that wall, you make the electricity wiring holes. So these holes, if somebody, they can benefit, or maybe you dig the foundation of the building. The customer can benefit. And how do you benefit? So what is the benefit? Benefit means you can use it, you can consume it, or you can sell it, but not as scrap, not as scrap, not at the throwaway price. So either consume or use or sell, or you can hold it in a way to generate economic benefits. You can hold it to generate economic benefits for future. So, I mean, when I say that customer can benefit, the question arises, what do you mean by benefit? Benefit means that whatever I have provided you, either you can use it, or you can consume it, or you can sell it, but not as a scrap, or you can hold it for future to generate economic benefits. You know, you and I, we agreed that this is your piece of land and I will make a farmhouse for you. I will make a house for you. And then I started making the wall, or I started putting the fence. So I fenced it all the way, and then somehow the work is stopped. And this fence remains there as the boundary wall of this plot. You can hold it and you can benefit it in the future, because tomorrow when you will, either you can start your construction of here. So if you make your construction, you will not put the fence because fence is already there. Or if you will not start construction, you can sell this piece of land. And while selling the piece of land, you can tell someone that the property or the land has already been fenced, and you can charge for that. So the normal piece of land is for $50,000, but because of fencing, you will charge $55,000 because it does have a fence. So it is called benefit. And number two, the second condition, the benefit from the goods or services can be either on its own, the benefit can be on its own, like, or together with other readily available resources. Like if you see this thing, which I put this the wiring hole in the wall, it does not give benefit on its own, but it gives it together with other available resources. So sometimes the benefit can be taken from that particular activity itself, but sometimes the benefit cannot be taken by itself, but it combines with some other thing. Like if you see the holes on the wall, there is no benefit. But when you will be putting the wiring inside, that is the time when you will get benefit, because you will pay less money to the next guy. The next engineer who will come in, you will say, my holes are already there. You just have to run the cables, and you will give less money and you will make benefit out of that. So either on its own or together with someone. So under first criteria, there should be benefit. Benefit has conditions: use, consume, sell, or hold, and it could be independent or it could be dependent benefit. The second criteria there, the promise to transfer a good or service is separable from other promises in the contract. Like it could be separable. It's a distinct thing. Like, fencing is a separate activity. Digging the foundation is a separate activity. Electricity is a separate activity. But putting the glue and then the wallpaper, these are not two separate activities. Putting the glue is part of putting the wallpaper. You cannot separate them. So performance obligation must be identifiable. It must be separable. It should be separable. The goods or services may not be separable from the other promised goods or services in the contract if these are insignificant integration services. I explained you already. So nothing much to speak here. Number 3 is determine the transaction price. Now that's important. Determine the transaction price, the total price of the building, the total price of the contract, maybe 20 million, maybe 30 million, whatever. And here, one issue which I'm going to discuss in next class, I will show you with the help of example, because this IFRS 15 we are going to cover in 2 sessions. Session 1 today, I'm doing the theory part, and session 2 next time, I'll do some questions with examples, with numbers, with double entries, because it's a long standard. So it is possible in transaction price, you have to allocate transaction price, and let's suppose that these performance obligations, let's suppose it is, I'll keep the number easy, 2 million, 2 million, 2 million, 2 million, and I don't know, one more 2 million, okay? So it makes me 10 million. Total, it should be 10 million, okay? But somehow you negotiated at 9 million. So when you negotiated at 9 million, there is a discount. There is a discount of 1 million over 10 million. So it means that you are giving a 10% discount. So actually this 10% discount is given on the total contract value. But then what you should do, you should allocate this discount to these individual obligations. So you should be giving 10%. So 2 million, 10% is 200K. So it makes me 1.8 million, 1.8 million, 1.8 million, 1.8 million, and 1.8 million. Because these are equal. So you need to do proportionate. If it is 3 million, you should give 10% of 3 million, which means 300,000. So because these numbers are same, so these numbers also become same. Otherwise, if these numbers would have been different, I would have given 10% on each one of them. So it makes me 9 million. So what you need to learn, that once you determine the transaction price, it is possible that the total is less than the sum of individual performance obligation. The sum of individual performance obligation was 10 million, was 10, but the total is 9. So you are giving discount, and that discount should be spread between different performance obligation on the equal percentage, on the equal proportion. So this is important to remember. So then you have accounting, again, determine the transaction component, very important financing component. You need to remember, and by the way, like I said, that I'm going to do all of these things in Microsoft Excel. We'll pick up some examples and I will show you the numbers. So right now it's only theoretical concept going on. Financing component means that it is possible that sometime you purchase some asset or some equipment and then you make a promise to pay after a significant period of time. Let's suppose that there is an equipment, you purchase equipment, the price you agreed for 100K and payment is made in 2 years' time, or let's even call it 1 year time, after 1 year. So you purchase here and you are going to pay money here, 100K. Now, one thing is for sure, it would have come to my mind that I will go to my supplier and I ask him that, see, you say that pay 100K after 1 year. What if I pay you today? What if I pay you in advance? If I pay you now, don't you think that there will be some discount? Don't you think that the cash price would be less? I think that cash price should be less than 100K, because he says, give me 100K after 1 year. I say, I'm giving it now. So if I say, give me now, he says, give me 95K. I'll be happy. If you give me 95K today, I'm fine. But if you pay after 1 year, I'll take 100K. So it means that this equipment is actually only 95K. And inside 5K is the financing component. Financing component means interest, because there's a concept of time value of money. There's a concept of time value of money. So this actually, the revenue here, the revenue is 95K. I mean, if you are selling goods. So, okay, let's suppose I'm selling goods. I'm not buying goods. Let's suppose I'm telling to my client that I'm selling this thing for 100K and you will pay me after 1 year. If you pay today cash, I'll take 95K. So it means my services, they have a value of 95. So I would be actually making a double entry like this. So in this case, there is a revenue, which is 95, and then there is a 5, which is called interest income. Okay, finance income. So 5,000 is not part of revenue. 5,000 is actually interest income. So significant financing component. Now, what is significant? IFRS does not define you. So usually we consider a material amount for a material period of time. If the customer pays for 3 years, 3 months, 6 months, we do not consider it. We do not consider it. Minimum 1 year. If it is 1 year time, and we know that we have provided some goods or services for 1 million and the customer will pay after 1 year, we need to consider that inside of that, how much is the revenue and how much is the interest income, and we need to separate it. We call it financing component. We should be doing it separately. Then you might have accounting for variable consideration. Variable consideration means where the price changes, where the price can change. For example, I'm selling some goods to my customer for 100K, and I say that if you pay me until 30th of January, 31st of January you pay, I'll take 100K. If you pay until 28th of February, I will charge you 105. If you pay me until 31st of March, which means 3 months credit, because I'm selling on 1st of January, so I'll take you 115. So now there are 3 possibilities. At the time of sale, if you pay me now, today, I'm selling you today, 30 days credit, you give 100K. You want a 60 days credit, 2 months, you pay 105. Or you pay after 31st March, it is 115. So actually the consideration, the price is changing. variable consideration. And in certain situations, we usually take the number which has been proved from history of the client, that usually this particular client usually paid. We know that. Then I give you information that based on the historical data, we can see that the client usually makes payment in 2 months time. The client usually pay in 2 months. So at 2 months is this much. So then I will book my revenue here, 105. Variable consideration also possible in case of returns. You might have returns. Some businesses, like goods, can be returned in any business, but in many businesses, we do not expect goods will be returned. Like if you are buying this shirt, you have a right within 14 days, 2 weeks, you can return back the shirt and take your money on or replace the goods. That's very legal way. But normally when these garment shops, they sell these shirts, they don't expect customers to bring in. Maybe out of 100 customers, 1 or 2 customers will come back. Not every customer will bring. But there are some industries where returns is a normal course of business. Imagine the dairy products, food items, other food items. It's a very common routine that customers, they return goods. When we sell goods, 100 pieces, we know that 3% or 2% is going to come back, because it's a milk. These are milk products. It has date of expiry. These are not sold on the shelf and they will be sent back. So returns are very normal practice. So this is different than selling the shirt. This is different than selling furniture. If you sell furniture, you don't expect that every customer will start bringing back furniture. But when you are selling, you are a manufacturer of dairy products and you have 3,000 shops as your customers, every shop is returning you something every day. So then your consideration again is variable, because 100 goods, when they go, some of them, they might come back. So we need to consider that as well. So let me just give you one double entry. Let's suppose I sell 100 goods. I'll explain it in detail in next lesson with the help of some question. A very technical question we will do. Here I'll just give you basic principle. And I know that 3% will come back, which means $3. Let's suppose each unit is $1. Let's suppose I sold 100 units for $1 each. And I know that 3% usually comes back. When I know that it usually comes back, I say debit receivable 100, because I have given the invoice 100, credit revenue 97, because I know that 3 will come back, and credit, I would say refund liability $3. You cannot overstate your revenue. If you write down here revenue as 100, that would be a mistake, because you are overstating the revenue. You know that it will come back. So don't put it in revenue. So leave it separately and put it as refund liability. And then after 7 days, which is the return period, because usually you give the return period, if the customer does not return the good, let's suppose does not return. The client says, I sold everything, I'm not returning anything. In that case, because you recorded less revenue, now you will say debit refund liability. You will not have any liability. You put it 3, and you would say credit revenue, and you put it 3. Receivables were already 100, so no need to touch the receivable. You decrease your refund liability because you don't have to give it now, and you increase your revenue because you before recorded less, 97, now you put 3 on the top. But let's suppose that customer return goods. If customer returns back $3 goods, and he said, see, I've got the right to return, I'm returning back, I couldn't sell these 3 units. It could be 4, it could be 2, let's suppose it is 3. So in that case, you would say debit refund liability, $3, you are returning it, and you would say credit receivable, 3. you will reduce your receivable by 3 because customer has returned back the goods, and you will do the refund liability. Now, there are some double entries for cost of sales as well and in warehouse as well. So I will explain those double entries in the next lesson when I will do a question. Here I'm just explaining you in a very short way, simple concept. If you have got any question, please ask me here. It might be complicated. Actually, I didn't make it complicated because I could make it very complicated in next situation. When I'll do a question, when I have to manage the cost of sales, we'll adjust the cost of sales for that as well. But even though if you have any question, please ask me. No questions, my friends? Seems like I'm speaking a lot today. Are you people still alive?
Yes, yes.
Yes, alive.
You know,
We're still digesting actually.
I tell you, there was something like after the Second World War, I read it like this thing, which I'm going to tell you. I read it in probably 91, 92 in some magazine, maybe 30 years ago almost. So after Second World War, the Japanese, they were like, they lost the war. They had this 2, nuclear bombs. So devastated nation, morally down. Japanese were strong fighters, World War I, World War II. They were very aggressive and they were very strong, actually, Japanese. But such a strong nation was down onto their knees and they was demoralized, devastated, injured, killed, destroyed. At that time, one of their leaders, political leaders, I don't remember the name, but I still remember the sentence. And he said that for America, he made that statement. He said that we will not shoot them to death. We will not shoot them to death. We will sell them to death. We will sell them to death, which means that we will kill them through trade, through business. And this is exactly what they did. They captured American economy so strongly. I mean, right after 1940s, the Second World War, you come back to 50s and 60s and 70s. In 3 decades, American automobile market was captured by Japanese automobile. American electronics are replaced by Japanese electronics. America, all the financial hub, heavily invested by Japan. So they said, we will sell them to death. So I can actually, talk people or speak people to death. I can speak so much. Okay. Accounting for consideration payable to the customer. It's the same thing. Accounting for non-cash consideration. Non-cash consideration we will discuss later again. Non-cash consideration means I have some product which the selling price is, I don't know, $100. I give it to you, and in return, you don't give me cash, but you provide me some service. So how do I value this, my product, or this, your service? Maybe your service is less than 100, maybe it is more than 100, or maybe you give me some asset. So this is called accounting for non-cash considerations. We will do it in next lesson when I'll do example. Then we say allocate the transaction price to each performance obligation. So first step, the contract. Second, defining the performance obligations. Third, contract price. Fourth, allocating of the total contract price to the individual performance obligations. The transaction price is allocated. The overall transaction price, remember you had that 10 million, then you made it 9 million, and then you have to allocate it to these ones. The transaction price is, which is 9 million, is allocated to each performance obligation based on the standalone selling price of each performance obligation. Standalone selling. So before we had 2 million, 2 million, 2 million. If it had been 10, I would give it 2. Because I gave a discount, now I will subtract the discount and make it 1.8. So this is what it means. Standalone selling price. Standalone selling price. If the standalone selling prices are not observable, They are estimated approaches to estimate. They are estimated. Standalone prices, for example, are not possible sometimes. If I ask you to do electricity from me, and electricity means putting the holes in the wall, then running the cables through the holes, and then putting some electric sockets. So it is possible that, somebody can tell me that they charge for wiring, $5 per meter. But that thing, when they say wiring $5 per meter, it includes all three things. But if I ask them, how much do you charge for putting hole? How much do you charge for running the cable? How much do you charge for this thing? They might say, I don't know. I never gave the price like that. It is not observable. I can tell you that the complete job I do for $5 per meter, per running meter. So in that case, you can make estimates. Estimates are adjusted market assessment approach. You take it to market and you make some kind of adjustments. You can calculate labor, you can calculate the time spent, the labor cost, etc. Expected cost plus a margin approach, residual approach, which means, whatever is left at the end. So you can have different methods of doing it. And these are the, 2-3 methods, but you might have a 4th or 5th or 6th method, anything which is possible, justifiable, logically correct within your current scenario. Because what is your scenario? It could be different every time. So that is the time you need to think about how to split this price between 2 different obligations. Allocating a discount, I already have told you that the discount on the total, you will see what is the percentage. I give 10% on the total contract. Then all of the individual performance obligations should also be reduced by 10%. I already have explained this concept. Variable consideration, I have explained this thing. I only need to do some questions for that. Variable consideration and financing component. These two I will do questions with you. Step 5 is recognize the revenue as the performance obligations are met, and performance obligations can be met over point in time, like delivery of the vehicle. When you give the keys, when you hand over the car, you can recognize the revenue. It could be over time, like warranty case. So as you provide the services every year, you can still recognize the revenue. And it says that the transaction price allocated to each performance obligation is recognized when the performance obligation is satisfied. Performance obligation is satisfied either over a period of time or over a point in time. And satisfaction means what? Satisfaction occurs when control of the promised good or service is transferred to the consumer. When I give you the keys, when you give you the car. So it means that I have given you the control and satisfaction is done. And it has conditions, ability to direct the use of the asset, because now you have the control of the asset. Control means that you have the ability to use it. You can take it home, you can drive it, you can park it, whatever you want, you can do it. Before it was in my possession, I had not given you the delivery, you could not touch it. Once I give you the delivery, it is yours. And ability to obtain substantially all the remaining benefits. The word is very important, all the remaining benefits from the asset. So whatever are the benefits associated with this asset, with this car, with this vehicle, you have this ability to obtain those benefits, not myself. So as these conditions are met, you can recognize the revenue. So this is like a 5-step systematic approach. It was not present in IAS 18. That was the big difference, because IAS 18 does not give you in so much detail, and therefore it was very easy. I have 10 million of total revenue. I can put 4 here and 6 here, maybe 2019 and 2020, or maybe I can say, okay, let's make 6 here and 4 here. It was quite possible, because this much of detailed guidance was not available. Now, still manipulation is possible. If people want, they can do. But IFRS has given you proper guidance. Before, guidance was missing. Now guidance is available. Now, how do you apply that guidance? That's on accountant's job. Any question until here?